recently the commercials got very bullish in here, higher than they've been for 12 months, and look where we were. And bonds are probably going to go up somewhere in the 114, 116 area now. Nice move. Why do we know it's going to happen? Because of the commercial activity. Any questions on commercials? I know that some of you here in the room have followed the commercials for a while. If you have questions, then feel free to ask them. This is the time to do it. Okay, you all understand. It's something you should watch. When you're looking for the highs and the lows in the commercial market, you know how to get the information. I have it faxed to me. You can get it on the internet if you want to, and it comes out every 2 weeks. And you're looking for 12-month highs, 12-month lows, areas of accumulation, areas of distribution. That's what you're looking for. And that each market is different. In fact, let's look at Canadian dollar. Remember when we looked at the data earlier, we said the Canadian dollar on the report we just got this week, they were substantially short. Well, let's take a look at the Canadian dollar. When the commercials got heavily long, it was in this time period, accumulated here, 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 and now look where they are. They're down here at a 12-month low. Those of you who follow my commodity timing service know we went short in here last October. Why did we do it? Because the commercials were at a 12-month figure. We also went long back in here. Why did we do that? Because we had a 12-month high and a huge amount of accumulation in this Canadian dollar. Now we're down, if I were to color in the other side of this, look where we are, like this. Interestingly enough, the technicians say, well, we've had a big price breakout here. This market should do whatever technicians think that it's going to do. It might. May well. It ain't the way to bet it, though. The other thing my dad always said to me, he says, Larry, he says, the fight doesn't always go to the biggest, toughest son of a gun that's out there. He says, but that's how you bet them. And by and large, he's right. Winners win. And what we like to do is speculate. The thing about Americans I love, we're all for the underdog. We always want to be contrarians, really. So we kind of want to buck these guys sometimes. You can't. You just got to, what is it? You got to go with what is. So while this may look technically very positive, I'm saying, okay, it's getting set up for a sell. This doesn't time the absolute entry of the sell, but it's telling me it's about time. I got to pay attention to it. I do want to touch briefly on the other players in that marketplace. Remember, we talked about the commercials, and we also talked about the large specs. I'm going to draw out the line. This is the British pound. On the large specs is a dashed line. I'm going to tell you what the large specs are. So you know who these guys are. The large specs are essentially trend followers. They get positive up here when the trend is an uptrend. They tend to come in actually late sometimes. They are trend followers. Those are essentially the funds. The large speculators are trend followers. The difference is the commercials are trend enders. There's an old adage in the market, the trend is your friend. Have you heard that? Absolutely right. The trend is your friend until the end. But nobody knows when the end is unless you look at commercials. And they say, oh, these are the trend enders. These guys stop the market from going up and going down. So the trend enders, that's who I'm interested in, are the commercials. The trend followers, they're just guys that have a moving average system or something. They're just the trend followers. That's the large spec. That's why I haven't been able to glean anything from their activity. Maybe there's something you can learn from them. I just haven't been able to figure it out. Maybe you people can, but I haven't been able to figure it out. I want to get involved with these guys that have a pretty good record. Let's see how good the record is here in the British pound. This is a 12-month high, 12-month high, here, here, and here, and here. Now look where we are. We're there, we're here, we're here, we're in this area. They accumulate for quite some time period in there. Look at this nice accumulation in here. Pretty good points to buy that market. So the best thing I can tell you is pay a lot of attention to the commercials to help you set up the trade. Well, as I mentioned, just having the commercial data may not be enough, because that just shows the market set up. And I also talked about the fact that the commercials can be early. And we want something that maybe fine-tunes this a little bit more for us. And we can use another group of players, if you will, in the market to fine-tune this more for us. And I'm going to show you that group. That group is the public. public is the other side of the equation. Unfortunately, because not everybody has had the Larry Williams videotapes, the public is pretty bad when it comes to trading. Well, that's an understatement. They suck. And that isn't just, it's everybody, because we get our emotions involved instead of reality, and we don't know what to do. And the exciting thing for me to be able to teach this information is there's fewer people now that are having disasters in the market because they've learned about stops, about the commercials, about how to trade. And that's exciting to me to see that we can create winners in the marketplace, that you can be a winner trading. I've had so many of my students have become winners because they've learned to do the right thing, that we're getting a more of an educated public. What scares me about that is when there's, if everybody learns this stuff, then there's no public. But fortunately, there's always a public. There's always schmucks out there who think, well, I wouldn't spend $200 for a videotape, and those same people will go buy a contract of gold because they don't like Hillary and lose $4,000, $5,000, $6,000 because they were smart enough not to buy some information. The trouble with information in this business of commodity and stock trading, it's either worthless or you couldn't pay enough for it. If they're absolutely worthless, it'll get you in trouble, or it's something that you can use for the rest of your life, one way or another. Well, if the public is wrong, how can we go about measuring the public? There's several ways we can measure this group called the public. I can do it technically, and I'll show you how I do it technically by looking at open highs, lows, closes, all that stuff. My good friend Jake Bernstein has a service where he calls up people every day, 50 traders, and asks, are you bullish on this market or bearish on this market? And that's a very short-term indicator of public sentiment, and it's pretty good for real short-term swings in the market. Jake had a real problem, though. Jake had a brokerage firm, has a brokerage firm, and one of the guys in the brokerage firm never had a winning trade. All of his trades were losing trades, lost all of his money. So Jake thought, would it be right if I lent this guy $20,000 because I can make a couple hundred just doing the opposite of his trade? Yeah. That was you were the customer. No. Now we know. No. But that's how extreme the public tends to be. There's another measure. See, there's somebody that's even worse than the public, though. That's what was the good news to you. There's a service called Market Vein. And Market Vein has found the best group, the most incorrect group. And you can get the data from Market Vein. Let me give you their phone number. They have a hotline you can call, and you can get the, if you subscribe to it, they'll give you their measure of investor sentiment. And that's what I'm going to be used. This is Market Vein. And the charts I'm going to be showing you, what I call the public, and it really isn't, is the Market Vein Index of sentiment. This is something that Jim Sibbett started, 25 years ago now, something like that, a long time ago. Jim Sibbett, I think he's dead now. He's a great technician, a good guy, really neat man. And his service has been carried on. Like I said, they found an even more incorrect group. They found that the group that's habitually wrong, the newsletter writers at brokerage firms, those are the ones that have the worst record. So they monitor all that, the bullishness and bearishness, the newsletter writers, people like myself, and theirs is heavily influenced by brokerage firm letters. So we've got a ratio of what percentage are bullish and what percentage of those are bearish. And I'll show you an example of how the public, or what I call the public, investor sentiment works. Remember, when the public is real bullish, they can't all be right. When the public is real bearish, market's probably close to low. That's really all you have to learn. We'll just go back to a chart over here. This is the Canadian dollar. And we'll take, now the sentiment index is at the bottom of this chart. Notice it's over 75% right here. Let's see how the public did in the Canadian dollar. They were 75% bullish there, and they were 75%, over 75% bullish there. Kind of good, huh? Yeah. I love these guys. Invite them over to my house anytime they want to come. Just grabbing, we don't have investor sentiment for euro dollars. Silver. Notice what happens. Again, we've got 75% bullish there, there. We're close to it there. We are here. Well, we're right there. We're right there. We're right there. We're right here. And here they got a little premature. Sometimes they can be early. Pretty good group. Now, the interesting thing to me, the public and the newsletter writers in silver are different than those guys who were writing about whatever our last market was. It's different guys. Here's the British pound. Different players in the British pound than in silver. Now we look at the public and we say, oh, the public's real bullish there. Look where they're real bearish. Down here, down here, down here. Look where they were real bearish. Right here. Look where they got real bullish. Right there. Now, they've since again moved to the bull side right here. That's why I know I've got to get out of my British pound pretty soon. The long British pounds. There's some huge profits in them. I'm getting close to a target. Hey, I'm going to take my profit and move to the sidelines here because these guys have moved to an extreme position. When they're extreme over here, the market comes down. When they're extreme over here, the market rallies. So it's the zone, somewhere in that 75-25 zone is what I'm looking for. Actually, about 65, 70%. If they're too bullish, I've got to be really careful about being long. I sure don't want to be long. And then I want to be a buyer when I see them down in these low levels. Here's the catch, though, about this. It's so hard to follow these guys. Because when I just randomly grab a chart, whatever this is, coin. When the public is way up here at the 75% area, as they are here, your emotions are going to be, oh, man, I don't want to sell that market, because you're the public, too. These guys are emotionally driven. When they're way down here, and they're very bearish, when I had 25% were bullish, you don't want to buy this market either, because you are the public. There's a bit of the public in all of us. So we have this great fear. See, this doesn't look like the time to buy. Remember I said the logic is turned upside down? This is when the public wants to buy up here. And this is when the public wanted to sell here. Because things look so bad, they want to sell. And when things look so bad in this business, that's great. I love famines. I love wars. I love disasters. I love droughts. I love all those bad things that happen because they make these markets move. And you've got to learn to like the opposite of what the public's doing. Here's soybeans. It's a huge crack in soybeans this year. Look where the public was, 75% bullish. Look where they were up here at the last. Look where they were over here. They were here, they were here, and they were here. Virtually everybody that I knew at this high in soybean market was bullish in soybeans, and nobody would sell them. And soybeans came down from, what, 840 to 660, something like that now? Big down move. Now, it's not let's look at the other side of it. Notice when the public was at their most bearish was right down here. 25% of them, in other words, 75% were bullish, and look where we were in the market at the start of this huge gargantuan up move. Guess what? They were wrong again. I mean, this is such an important group to follow. But there's a problem with the group that we also need to address. Take a look at gold. I'm going to put this in a different color ink so we can see what the public's done in gold. When the public got 75% bullish here, here, back here, and over here, look where we were. We were here, we were here, we were here, and we were here. Public had a nice record of calling the highs in the gold market. And when they get very bearish, look where we are, really here, over here, and we're not quite there yet. But we were in this zone for a buy, this zone for a buy. So I like to see this get down to that 25% area. The public is just washed out of the market. They're thinking there's no way this can go higher, and that's when the markets turn. Now, I'm not the only person smart enough to figure this out. Other people have noticed it. But there's also problems with this investor sentiment data because sometimes they're real early too. They get bullish, the market corrects, and then it goes to a new high, as you saw it doing wheat and soybeans. My contribution was one day I had this flash. Oh, I just got real clear on these relationships. And I'd like to show that to you. The clarity that I saw was a betting situation. I can bet on the public or the commercials. Which one do I want to bet on? The commercials, right? And we've established that point. But the commercials can be early too. But what about when these guys are in total disagreement? Yeah. When these guys are long like crazy and these guys are short, that's the time I can say, okay, I've now got a setup trade. Or when these guys are short and these guys are long, that's my setup to be a buyer. And this is the sell. So I want these two crowds diametrically opposed to each other and hopefully at an extreme. I want the commercial so bullish and I want the public so bearish. That's the setup I'm looking for. And it doesn't happen all the time, unfortunately. It doesn't even call the highs and lows. There are other highs and lows that can occur without this phenomena being there. But when the phenomenon is there, that's about as close as a locked-up deal as you're going to find in the marketplace. It can still be early, though. So again, we have to bring in the technical tools to time us to get in and out of the market. But it's that juxtaposition of those two crowds, the commercials who are just wildly one way and the public who's wildly the other way, that's what sets up the optimum trades. That if there's any inside information in the marketplace, there it is, you got it right there. You want to get those two groups totally upset with each other. And then you got a deal going. And we'll look at some examples of that now. Well, here's our Canadian dollar. We talked about this earlier. Now notice, if you will, that at this point in time, the commercials were heavily long in here. And finally, the public, now they started getting long here. That's really pretty premature. And we said that can happen. Remember that? That's why people look at commercials and say, well, commercials aren't so good. And my point is, when these guys are long and at a 12-month high, they've been doing a lot of accumulating, and now the final ingredient is this. When at the same time, the public gets very bearish. They're below 25% here. Only 25% of them are bearish. 75% are bearish, 25% are bullish. Now look where we are. We're right in here. Now you can throw a dart, you can buy an option, you can do a trend line breakout, you can do an oscillator, a whirligig, anything you want to do for your technical entry system. You can use the Beverly Jaeger system if you want to even. You know what that is? There was a lady in St. Louis, Missouri. She had this great system for trading the markets. I bought it. Cost $1,000. She claimed she'd made a lot of money. Her system was this. You get your chart book, you cut out your charts, you put each chart in an envelope. You mix the envelopes up so you don't know which chart's in which envelope. Hold it to your forehead. If it's warm, you buy it. If it's cold, you sell it. That was what she did. I paid $1,000 for it. She had a great track record. You could probably do the envelope technique, you know. So what day to get in? Monday's warm, Tuesday's cold. Buy on Monday. So much stuff is there when you get this confluence, if you will, of the energy in opposition. That's what sets up your trade. Now the opposite side, finally these guys start to get pretty bearish in here, and the public gets, now we've got them in opposition right there. See how they've come together? Oh, we're at a high in the marketplace. Then these guys get the other side. They're all matching. They're opposed to each other. Then we have nothing going on here. Actually, the commercials are bullish in here at these points. And these guys are not down to 25% though, so we don't have an ideal trade. We finally get above 25% up here. Oh, look at the commercials. Da-da-da-da-da-da. They're right in here. They're real low, not as low as they've been for 12 months, but historically they've done a lot of short selling, and the public is 75% bullish. They ain't going to be right. So there's your sell point. Currently, we have a case where the market sentiment has the Canadian dollar close to 75%. It may have even gone there this week now. I check my numbers and see, and the commercials are heavily short. We've got a 12-month low in commercial short selling, and the public's at about 75%. I don't know, the Canadian dollar is going to come down for sure. I can't tell you that, absolutely, but that's why I'm going to trade it. You know, and it's too good of a relationship of these things over the years of getting these two crowds in opposition with each other to say, okay, now the trade is set up. And again, it doesn't mean pull the trigger today. It just means the trade is set up. Let's look at a couple more of these. Soybean oil. Here's the public down here. I'll mark their high readings. Ooh, look at this now. Ooh, that's exciting. 15% bullish down here. A little bit there, a little there. So these guys, at this point in time, the public is very bearish on the market. And I then go and say, what were the commercials doing? Well, the commercials were net long. Notice how the jaws of the alligator had opened up here, right? These guys have been long, these guys have been short, and where are we? Ta-da, a low in the marketplace. Over here, the commercials get long, but the public's not blown out yet. Finally, that happens really over here. They're long. We've got the jaws have opened up here. We're at our 25%, and we're here and here. Then we get up above 75% here, and look where the commercials are. And look where we are. I mean, I feel like David Copperfield. There it is, guys. I mean, I'm not going like this with a beautiful girl, but this is commodity trading. I want a pork belly. Not with a girl. I'm going to show some more examples to just drive that point home to you. So you see it. So much of what we learn is by repetition. If you see one chart, you say, well, maybe Williams has got something there. But you see a bunch of them, hopefully you're going to say, hey, there's something going on there. Question?
Larry, you said that bonds follow the euro dollar, and I was curious if the public sentiment and a commercial indicator in euro dollar would also match or need to match what's going on in bonds at the same time.
It wouldn't need to match. I like to trade each market on its own. Euro dollars may lead the bond market by maybe a week, 3 weeks, a month. So to use euro dollar data may be premature getting me into the bond market. I want to look at the commercials and the public and the bond market to look at the bond market. That does raise an interesting point that I want to make, is that markets are different. People that trade the S&Ps are not the people that trade hogs. The margin on hogs is maybe $400, $500. The margin in the S&Ps is $15,000. So I ask, is that a different player? You bet it is. The predominant influence in the bond market is a lot of commercial activity. Is that different than people trading cattle? You bet it is. Markets have different characteristics. The same set of data that influences, say, pork bellies doesn't influence the bond market or the Swiss franc or the British pound. So I look at each market on its own because they are unique. They're just like people. They are unique in and to themselves. And some people, like my good buddy Tom DeMark, thinks he wants the exact same system for all markets. And I can understand that viewpoint, but if I can find things that give me a bias in my market, I'm going to use them, even if they don't mean anything to another market, if there's an intrinsic reason why they should be influential in that market. Well, let's look at wheat now. We looked at wheat, and we saw that earlier we had a bit of a problem in wheat because the commercials have been short, really, for quite some time. The commercials got short wheat, really, this entire time in here they have been short. But notice that the only times they got in opposition to the public, we had it here, we had it here, and we had it here. So I can refine and get rid of some of the bad commercials where the commercials are too early by waiting for the public to also get set up. Notice the commercial started buying here, but we didn't get our low readings from the public until in here. So I can use this as a fine-tooth comb, if you will, to get me closer to the truth. The commercials were pretty bearish early on here, but it wasn't until in here and here that the public finally was wildly bullish on this market. Same token over here, this entire rally, look at all the selling of the commercials. But it wasn't until here and another shot here that the public was at an extreme. I'm obviously stopped out of this trade with a loss. I come back again here, they're still short, heavily short, the public gets to an extreme, there's my second shot, and the decline unfolds itself. So part of the reason for using the public is to make certain that I'm not too early. Just the commercials being there may be too early. And by waiting for the public, I get closer, and I'm going to wait even a little bit more for the market to technically give me a sell signal or a buy signal. But for establishing a trade, for knowing anything about the market at all, if you just want to go to a cocktail party and be able to make sense and understand what's happening, you women want to know what's going to happen with the price of coffee or wheat or bread or whatever, you're going to get a great sense from here of, oh yes, this market is under accumulation and the public's on the other side, and that's what you're looking for. That's in my search of the market is the singularly most powerful element that I've been able to find to establish major moves in the marketplace, where you can take small positions and have a large move and make a lot of money. This is if there is a surefire way of trading, this is the surest fire way that I know of getting these trades established and set up for major moves in the marketplace. And that's almost exclusively what I spend my time doing. As you can see, you know, the nice thing, as I said, about my stuff is it's not very complicated. I mean, to do a Larry Williams trade, you just grab a chart and you say, okay, well, where are we? And you come over here and I say, well, the commercials are just slightly positive, and these guys are not at 25%. Next page in the chart book, please. That's it. I'm done. I've got my analysis done for the week. Actually, for probably a couple of weeks. So I like the idea of keeping it simple, as opposed to having all this stuff around me, fancy computers. I go in some guy's offices and they say, look at this. This was, for instance, he had like 7 computer screens. He said, look how big that one is. I was huge like that, you know. And he said, what are you doing for quotes? And I have like a beeper that gives me quotes on it. I said, here's mine. You know, on the hour they send the closing prices of the British pound and the S&Ps and the bonds and the stuff I'm looking at. That's it. That's my quote machine. That's as complicated as I want it to be. Now that fits his lifestyle okay. That's what he wants to do. I just does not my lifestyle. It might be yours. Then get into all the technology, because there's incredible technology there that's available now. But I'm saying you don't have to do it. You can do this as an avocation, as a hobby, and do probably as well, if not better, than this guy who is glued to the minutia on those screens. Well, let's look at some other techniques that we can use. I'm going to go back to my friends, the commercials, again, and show you how we use that thing I mentioned in the first tape called open interest. And I didn't really define open interest very well. I'm still not going to, because it just gets you confused. Open interest is a reflection of commercial activity, though. It reflects commercial activity. Important point, please pay attention. The commercials make up about 80% of the volume in the marketplace. And again, remember, open interest is a representation of volume. So the commercials are the dominant influence. They're about 80% of all the activity. So if the open interest starts to decline, in other words, there's less, it shows that there's less activity on the part of the commercials. If open interest increases, it shows there's more activity on the part of the commercials. Second thing you need to remember, the commercials are usually short. They're hedgers. Commercials are usually short a market. They're selling, they're hedging into their positions. So we know the commercials tend to be short. Therefore, if open interest increases, they're probably increasing their shorts. If open interest decreases, they're probably decreasing their short position. That's how open interest can help us. If open interest is increasing, the volume of the market is increasing. And since commercials account for most of the volume, and since commercials are usually selling, it's probably short selling coming into the marketplace. If open interest declines, it indicates the commercials are probably dropping their activity. And since their activity is usually what? Selling. It probably means they're buying, or they've at least stopped their selling. They're not aggressive short sellers. Now, the way that's going to work is if open interest declines like that, open interest down, that's bullish, with a caveat. If open interest goes up, that's bearish, with a caveat that I'm going to give you. The caveat is, this ain't always true. but in a trading range. When prices are in a trading range, prices have been coming down like this, and now they start to go in a trading range like this, and open interest starts to rally like that. I can say a couple of things. First of all, this trend is down, right? And open interest is increasing, so the commercials are probably adding to their shorts. So I would expect a breakout for this market to the downside, and I would want to sell a breakout or whatever technical thing you want to use. I would probably want to be looking for a sell signal. Again, the nice thing about my stuff, just flip the thing upside down. If the market is rallying and open interest is coming down, they're probably liquidating their shorts, and I would expect a rally to break out to the upside. That's the pattern. It's in your Money Tree book, in your Batting 800 book, so you can refer to that in the pattern. Now I'm going to show you some examples of it. I think that's what we've got here next. Let's just take a look and see. Well, we have Treasury bonds in a pretty well-defined trading pattern. Look what happens to open interest in here, and then look what happened to the bond market. Open interest declines. How much of a decline do you want? I'd like about a 30% decline in open interest. That's a rally for a sell and a decline for a buy. In this trading range, really open interest increased a lot in here. The market came down, still trading range. Big peel off in open interest. This market is going to rally. Lo and behold, it rallied. Now, what I love about this technique, this is something I first wrote about 26 years ago. In 1970, I wrote about this technique. I wrote about the commercials, wrote about all this stuff back then. Nothing's changed. Still at work in the marketplace. Crude oil. Let's see what's happening in crude oil. We had a trading range in here. Open interest pulls off in here. They've liquidated their shorts. Crude oil starts a big up move. Now notice in here, it's increasing. Open interest is increasing, but we're not in a trading range. The key ingredient, you must be in a trading range and then see the open interest do its thing. You've got to be, and I want to emphasize again, you must be in a trading range. If you're not in a trading range, you're in a trending market, I don't know what to do with open interest. I can't make anything out of it. I need a trading range to be able to get some knowledge and insight into the market. Here's crude oil. We're in a nice trading range in here. Look what happens to open interest. Gosh, what way are we going to break out of this trading range? Well, I'm going to bet to the upside. Why? Trading range market, it had been in an uptrend. Open interest peels off to the downside. Hey, that's a nice signal. It gives you some insight. It's like those tracks in the snow of the deer. It gives you some insight into the future direction of this market. British pound. Well, we're in a trading range in the British pound. Somebody asked me earlier, gee, British pound trade Rindler, how did you know that was going to go up? Why'd you buy it? Well, look at this, guys. Look what open interest does in this trading range. Big peel off. Huge peel off in open interest. Then the market, actually, the market went up this week to, what, 160.40, something like that? We've moved up that far now. What tells us that? A, the commercials have been heavily long the market, and now we get a pull off in open interest during this trading range. I better be taking buy signals in here. Canadian dollar. Now we've talked about Canadian dollar right now. The commercials are heavily short. The public is heavily long. Look what has happened in open interest. A bit of a trading range in here. Yeah, this thing is starting to set itself up. Soybeans, a big trading range. What happens to open interest here? What takes place in the market? By the same token, in this trading range in here, open interest came down. Big flash flood rally in the soybean market. Again, we get back down in the same trading pattern or trading range. Open interest declines. In comes our rally. And again, to me, the most thrilling thing about this is 26 years of looking at open interest. To see it just as alive and well today as it was back then when we first stumbled into this relationship. Soybean meal. Soybean meal gets into pretty good trading range up here, open interest. Same trading range we had in soybeans, open interest declines, the market rallies. Now this is not as black and white or as simple of a tool to use as, say, the commercials, but it's going to help you a lot. Let's see. Trading range in here, downtrending market, open interest increases. Look at the increase in open interest in here, down comes the market. It's like classic book. It's interesting teaching this to so many people. I'll have people call me up and point out these things to my attention that I haven't noticed. Say, oh, did you notice, Larry? And I had a friend call me up this year for one of the big rallies in the grain market. We had a huge, he says, this is the mother of all open interest reductions. And it was, and sure enough, the markets went up. Nice little trading range in here. Open interest peels off dramatically in there. Up goes the market until open interest increases. Ironically enough, open interest is something that has not been focused upon much in the books, in the classical literature about this business, and their interpretation is totally different than mine. They want price up and open interest up. The thing, though, is the trading range. You need to put it in context of the trading range itself. You've got a trading range in sugar, a breakout to the upside, out, sold in here, so stopped out, sold again over here, and we covered our shorts, I think, down here. What got me negative was the commercials, the publics, and also look what's happening to open interest in here. During really a trading range, even though we broke out to the upside, huge increase in open interest. I wanted to be short. Now, currently, if sugars move sideways in here, I'd like to see open interest start to peel off like this as we continue moving sideways. That would really, I don't know that will happen. But if it did, that would excite me about this particular market. I'm going to take a look at a couple more. Lumber, trading range market in here, look at open interest. Trading range market in here, look at open interest. Open interest comes down, trading range market, prices move higher. So this should be another one of your tools then that you should use. I'm going to give you actually 7 tools here. The first tool is going to be the commercials. Second tool is the public. Third tool is open interest, which is a reflection of commercial activity. Those are the first 3 tools. I'm going to give you a 4th tool now. This is spreads. I'll define spreads for you.
Larry, for the open interest, do you use the total open interest per commodity or the open interest per contract month?
Great question. When you look at open interest, you want to look at total open interest of all the contracts. We get volume for each contract, like the June, the September, the December, and open interest for those months, but you want the combined open interest and the combined volume. The reason being that you may be liquidating open interest in the nearby, but building it up in the distance. So look at the total open interest. Great question. I appreciate that. I get that a lot from people. Look at the total open interest, not just one individual contract month. Look at total open interest. Okay, let's talk about spreads. One of the great things about the commodity markets, as I said earlier, is there's a relationship that we don't have in the stock market. Because we have, say, a January contract, a March contract, a May contract, a June, a SEP, and an October, whatever this market is, doesn't matter. These months sell at different prices. The January contract typically might sell for, say, $4.80, whatever it is. The March may sell for $4.90. This is $5. This might be $5 also. This is $5.20, and this is $5.30. As you go out in time, what happens to price? Price goes higher, right? That's the way the markets are most all of the time. Reason being, whoever has that commodity for delivery next October, a year from now, has interest, storage charges, insurance, and the fear of the unknown, which is great in this business. So typically, markets in the distant months, we call those the distant months out there in time, sell for more money than the nearby contracts. That's the way the markets are. It's called, actually, a carrying charge. We have a term for that called a carrying charge. This is a carrying charge market. That's the way the markets almost always are. They're carrying charge markets because of those unknown and real costs of holding the commodity. On occasion, there's an inversion in the marketplace, and this whole carrying charge thing is inverted, and you get a market that looks like this. The January will sell for 530, the March for 510, the May for 5 even. Maybe you've got 505, 490, and 460. Again, these are just numbers to make a case. Notice here, nearby sell for more money, don't they? Well, why would that happen? Interesting question. If my basic thesis, the underlying thesis about Larry Williams is commercials are what it's all about, because they represent 80% of the volume in the marketplace, somebody's bid this nearby contract to a premium over all the other markets. Now, who would do that? Would we, the public, do it? No. A, we don't have that kind of holding power, and B, we don't have that kind of money. You're talking about a huge force to have an inversion and go to what we call a premium market. This is a premium market when the nearby you sell for more than the distance. What this means is somebody wants this market so badly they're willing to pay more for it than for the distance. That's very bullish. But like all this stuff, you need to know how to interpret it. So I want to first establish this point, and then I'll show you how we interpret this information. It can be interpreted in several fashions, but the first thing we want to do is look for, do we have a premium structure in the marketplace? That, in and of itself, is bullish. But there are several ways to read it, and you can just get your Wall Street Journal Investors Daily and look through it and see price of corn and see if you're at a premium. Is there a premium market? Or you're at a carrying charge, at a carry. Or some people call this a discount. What is most significant about this is that this is my difference between, say, the January contract and the March contract. I'm going to simply subtract, in this case, the January from the March. The March is at a 10-cent, the January is at 10-cent discount, isn't it? Whereas here, the January as a 20-cent premium. It's over the March contract. So we put a little plus-minus line. And in the case of the March, that was at a 20-cent premium, I would put it up here. And you plot this daily or weekly, whatever you're looking at. Usually, we're at a carrying charge market. We're below. The nearbys are selling for less than the distant months. When this happens, when you get across, that's very bullish. At this time of the crossing, if there's a on-off switch, this is an on-off switch. When you go from a carrying charge to a premium market, that's bullish right then. That says this market's ready. It's in tighter hands. It's in commercial hands. This is not in the public hands now. This is the commercial market. This is a commercial bull market, in fact, may well be developing here. So you want to pay attention to that relationship, what we call spreads or premiums, or an inversion in the marketplace. And that's telling us somebody wants this so badly that they're willing to pay a premium for it, and we know who wants it so badly, the commercials, because they're the only ones that want the commodity. They want to take physical possession. How many of you want to have a bunch of cattle delivered on your lawn some morning? Probably don't, do you? Your wife's out enough problems that you're keeping a chart book. You know, let alone somebody knocks on the door. Is this the house where we deliver the pigs? You don't want that. But they want it. The commercials want it. So they want to take this, and they'll buy it because they need it now, and they'll drive the market to a premium. As they drive that market to a premium and it goes positive, that's a very bullish sign, and I want to be looking at this point to be long this market. That's a bullish indication that I should be long this market. Now, what happens is the market may be coming along like this. It may even start to go up in here about this time period. You may not call it the absolute low. It doesn't matter. Then the market continues moving up, and people who've read my work will say, well, there's a premium in the market here, Larry. This must be bullish. And my point is, no, not necessarily now. It was bullish back here when the premium came on the board. But now we have to look at something else. The something else is, how is the premium doing versus the price structure right now? Notice here we made a new high in price, but the spread is starting to fall apart, or it's deteriorating a little bit. So once you've had a premium, you then need to look at the relationship of the premium to the market itself to see the interaction. But it's this is the big thing that's very bullish, and it's a bullish bias when you've got a premium, but I still want to focus in on the relationship between the premium and the actual market price itself so I can monitor and tell what's happening. Typically what will happen, this market will come down like this, and the spread will do something like that, saying, gee, in the face of weakness, they wanted even more. They wanted that nearby contract even more. That's a nice buy signal, and this market will go back up again. So I will use the spread in two fashions to help me time entries in divergence between premium and spread, and to say, uh-oh, we're in a commercial bull market. And there's a big difference here between commercial bull markets and what I call speculative bull markets. We've got two markets here. Now notice both of these markets started at the same point, we'll call that A, and they both ended up at the same price, B. Is there a difference in how they got there? Sure. This is pretty wild, isn't it? This is a public bull market. This is a commercial bull market. In a commercial bull market, you buy it, dive under the covers, wrap them around you, turn the electric blanket on to 9 and assume the fetal position. And hold on. In the public bull market, you sell the big rallies and buy the big breaks. Sell the big rallies and buy the big breaks. They're different markets. They both get to the same point, interestingly enough. But they do it in a different fashion, and your trading strategy needs to be different. This market doesn't have a premium. When gold had its big run-up and silver had its big run-up 10 years ago, whenever it was, this is how it's traded. But there was never a commercial bull market. It was always public. There was no premium. At some point, we'll have a premium in gold in the next big crash, whenever that is. Maybe in my lifetime or my grandkids, whenever it comes. But there will be a premium. And that will tell you that's the buy and hold market until the premium falls apart. But you need to trade them differently. You need to say, what am I in here? Am I in a commercial bull market or am I in a public bull market? So there's a third way then of using spreads. A, when it goes from negative to positive, you're in a bull situation. B, to judge the strength of the market as you're trading it. And C, to say, oh, I'm in a commercial bull market. Or, no, I'm in a public bull market. Different strategy. Different strategies necessary for those markets. Well, given that information, let's take a look at some of the spread relationships. Let me show you first what causes that, how that can develop. This is the case of October hogs versus February hogs. And notice the October contract is a lot stronger than the February contract, isn't it? Quite a bit stronger, huh? Makes new highs. This doesn't make a new high. Which month do you think the commercials wanted? They want the Octobers or they want the Febs? Yeah, they want the Octobers. They're really goosing this one up, aren't they? Whereas this is not doing it. Now, a third thing and here's the spread down here. This is our spread coming along here. The third thing I can tell you about this, and this is a real important insight, and so I want you to listen up to this, especially those of you who watched this tape before. It's this. Once this October goes off the board, what do you think is going to happen to the Fed? Now, the Octobers have been in a strong demand situation. Commercials have wanted it more than the Fed. Will they get back in and start to buy the Febs now like crazy? Probably not. Probably the deal is all over. In other words, they want it now, and the fact they're not pulling this one up with it means once this is off the board, you can sell this one short. To confirm that, you would want to look at Feb versus the next month out to see if Feb is gaining on the next month out, just to make certain. But this is one of the nicest situations you can develop, is when you get a situation where the nearby is strong and the distance don't come up with it, and this goes off the board. It's like, that's it, deal's over, game's done. You know, this isn't time out, this is the end of the game. The World Series is over. So look for that relationship as well. We currently had one in cattle developing. See if we did. Yeah, look at the huge difference that developed in this market. October live cattle, it just makes all kinds of new highs in here, huh? Now, if you happen to raise cattle and you want to sell or do some hedging, where are you going to do it? You're going to do it in the Febs, not the Octobers. And you're probably going to say, you know, when this Oct is off the board here, this is where I can do my short selling. Or if you're negative in the cattle market, instead of doing your negative stuff here, you'd be doing it here. And it's so clear to see that here, but we'll end up looking at it at the spread to help us also look at those relationships. But this is what it'll actually look like. You know, you think cattle is cattle is cattle, right? Rice is rice, wheat is wheat. That's true. It's the same protein content, same iron content of these animals as these animals. Everything is the same, except these are in more demand. That's different than a stock. The stock of IBM doesn't have that timeliness. Nobody needs to take delivery before Christmas. Here, somebody wanted the delivery of these October cattle. So you get in what we call a squeeze play, where you can actually be long the Octobers and short the Febs and make money, because these are going down and these are going up. So you can actually make twice the money if you're on the right deal. The guy who was my mentor, who taught me so much, Bill Meehan, just worked squeezes. That's all he did. He'd just wait until he got a squeeze situation. This is a Bill Meehan market. He'd love this market. He would be long the Octobers and short the Febs and be in the squeeze play, because the squeeze comes in this nearby, not in the distance. See, new highs in here, you just don't have it. So when this is off the board, this is where you want to be selling short. Well, in the last hour and few minutes, you've learned about the commercials, how to look at the commercials, how to look at the public. This is the integral part of the market. This is the most important part to help us identify buying and selling opportunities. It's not the timing part, and there's still a few more big guns I'd like you to see. We'll do that on the next tape. But if there's a heart of what Larry Williams is all about, is this tape. This is probably the first tape you should rewind and watch again, 2, 3, maybe even 4 times. This is going to tell us when these markets are set up. When you're through with this, then get on to the next tape where we'll talk more about setups and then how to actually get in the market to be a buyer or a seller and how to set your stops. So get on to the next tape, and I'll see you there.